music that introduced David and I was Salome's Dance of the Seven Veils, and it's amusing because David and I and our wives were at the Sydney Opera House watching Salome, and then I made a big impression by buying him dinner underneath the Sydney Harbour Bridge, which is something that's memorable. But the music is inapposite, and the reason is there are no seven veils to David Harquail. I mean, basically, what you see is what you get. And I say that because I met David in February 1987, where you may find it hard to believe. I was up on the stage at an epithermal gold conference, and he was a junior mining analyst. But he was asked such sensible, intelligent questions that I thought, this guy is really interesting. And then about 4 years later, he introduced me to Pierre Lassonde. And Pierre is just one of the most remarkable people that the mining industry has ever had. And being with those guys just blew me away. Now, they didn't give me any money. The other guy that was there, Rob McEwen, he gave me money. Harquail and Lassonde didn't. And Lassonde said, this Moneta project is very interesting, but come to us last. And that was, it gave an insight into the low-risk approach of Franco. So that's the prolegomena. But why David's here is because of what he has achieved. And it's not for himself. This is basically for the mining industry. And Franco was established with one royalty. Now it's got, what, 250 producing royalties?
It's over 100, but 416 royalties and over.
415. So it started with one royalty way back in the 1980s, and it's now a $38 billion corporation. Now, I call that a lifetime achievement because David's been with it throughout the journey. But really what we need to know is a bit about you and mining, because you've been mining since you were a child, really.
Yeah, actually, Tom, we're both the same cut. We're both mining nerds. And I was born into it. My dad was a mining exploration promoter. I grew up, he was go to the prospectors conventions. And in those days, there weren't these intermediaries in terms of brokers raising money. You raised your money directly from individuals. And so at the Royal York Hotel, where they had the prospectors convention then, he would take a suite. He would actually have his own colored maps because there wasn't coloring and photocopying in terms of color those days, spread them out in the bed. And then these dentists and doctors that were looking for, investments, they would come in. It should usually be early March. They'd be saying, what's next year? What's this summer's drilling program? And they would write a check in that room. And my dad was too cheap to buy the hotel booze, so my job was to go down to the car and bring back more rye and whiskey, as needed, to lubricate the marketing process. And so he had 7 different companies on the Toronto and Vancouver stock exchanges. I got to work as a geologist assistant, as soon as I was 11 or 12, be out in the field. Spent all my summers in the exploration business. I did exploration geology in university, and I found that I wanted to be closer to head office. So I went back, got an MBA, and then I got more into the mining finance side of the business. But it's been mining exploration all my life. I thought there was nothing more Canadian than to be out in the field. The head offices were in Toronto, and so we could have a global perspective on the world. So that's the story.
It's actually lucky you're here, because way back then in the 1980s was when a disgruntled investor shot the promoter in the lobby of the Royal York Hotel.
I was at the convention at that time. Yeah.
Right. So I mean, sometimes in mining you can be lucky.
Yeah.
But this gave you a base, and you took it. From the interest, you developed the academic requirements to be able to do pretty much anything in mining in North America. But you were then a mining analyst before you joined Franco.
I did a couple of things. I worked in exploration for a while. So those times the oil companies were involved in mining business. Shell Oil had a big mining exploration effort. I worked for them for a while. I worked for Hudson Bay Mining, mapping their Tom and Jason deposit up in the Yukon, which is still not a mine, but it's an interesting deposit. And then I worked for a company called Chase Econometrics, selling consulting services to mining companies. And it was an interesting company because I was a Canadian representative, and they were selling econometric models for the global economy. And they thought they could drive it down to where you could actually forecast aluminum or extruded or fabricated steel demand by postal code in the US, or they could advise governments or companies in terms of what was copper going to do well or not. So in my 20s, I was calling up the CEOs of companies saying, do you want an expert opinion in terms of, for instance, Cominco had the Highland Valley copper mine. They had to decide whether to expand it or not. Their major shareholder was Canadian Pacific, and they needed to convince Canadian Pacific that there was a future for copper. So I actually got the contract for Chase Econometrics to come in and sell the board of Canadian Pacific in terms of they needed the study to make the capital decision. We also advised, like the New Brunswick government, whether they should force Noranda to have a zinc refinery in the province of New Brunswick. I even got a contract from Iceland in terms of studying the aluminum industry and what was the future for more and more aluminum expansion in Iceland. So it was great because I got involved with some companies. I learned the politics. We tried to convince the British government to force a smelter to be built for copper in British Columbia, and I almost was attacked by the George Albino of Rio Algom because he knew it was going to cost the mining companies more money to have their own smelter in Canada. And he'd rather have the Japanese subsidize smelting rather than paying for it. So it was very interesting, gave me a broad concept. Then I went to go do mining loans at the Bank of Montreal, and with short time because it was too bureaucratic. And then I worked corporate development for Denison Mines when I was then headhunted to go to join Pierre and Seymour Schulich. And what was ironic, I got a lot of calls to become a mining analyst from different brokerage houses.
Indeed.
And I said, now most of them are idiots because I used to sell them studies from Chase
But they
Econometrics.
weren't idiots in London, they were idiots.
No, it was just the Canadian ones. I didn't have the London contract, so I didn't get to know the firms here. But I was always impressed because I went to see Butel Goodman and Pierre Lassonde and Ned Goodman, and they said my stuff was shit. And I was very impressed by that because they're the only ones that push back on the quality of the stuff. And I said, the only guys I'm interested in is Butel Goodman. And it turned out at one point that it was them recruiting for a new mining person. And that's how I ended up partnering with them.
Yeah, but what that's a tribute to is the insight of Ned Goodman, who was a great man, and Pierre Lassonde, who is a great man and who's quite capable of talking me off a platform. But
Yeah.
what happened next was that it was a team that started Franco Nevada, really. And they bought your knowledge capital very wisely at the time. But Franco Nevada, really, it's just so much accumulation of data and information. It's an encyclopedia for the American mining industries.
I look at it differently. I think we came at it from a perspective that we were investors in great geology and great deposits. And I remember the firm that Pierre and Seymour and Ned Goodman were working at was an investment firm. We ran pension funds, we ran specialized gold funds, we ran oil and gas funds. So we're just trying to make money for our pension clients and investment clients. And the frustrating part of it is we could recognize, because Ned Goodman was a geologist as well, and Pierre was an engineer, great deposits. And then we see these people that, find, for instance, the Hemlo gold discovery. And if they just kept that, it would have been fantastic. They diluted away. We saw American Barrick have Gold Strike. If they just stopped there, it would have been fantastic for the shareholders because that was the mine that generated the wealth. And so we were saying, we want to have something where we don't get diluted away. And that's when, Seymour, back in it was 85, 86, saying, well, I'm running these oil and gas royalty funds. Can't we do something similar in the mining industry? So we actually started off, we continue to be professional investors running these gold funds and mining funds, but Franco Nevada was on the side. It was basically another closed-end fund that was just doing mining investments. And I would actually tell mining companies, we're a gold, we're pension fund managers, but we also are looking at royalties on your properties. I want to make sure you don't have any conflict because we're looking at all angles to invest in your property. So I had the best of all worlds as I would be looking at these equity investments. I would be getting educated by the CEOs of these companies telling me what was fantastic about the properties, what was the upside. And at the same time, say, well, if I really like it, I can buy the equity in that company, but I can also look, are there any underlying royalty interests? And so we acquired quite a few that way. And the other advantage we had is you have to do lots of investments before you get good in terms of finding out what are the right people, what are the mistakes that can be made, et cetera. Because we were doing a lot of investments in gold funds, I kind of felt like I went to school with other people's money. And I ran all these investments, and you go back and you have to account for, why did I lose money on a particular investment or this particular deal? What did I miss? And you get smarter. You make your sort of point list in terms of what to avoid going forward, what type of people to associate with going forward, what type of consultants to use. And so you just get better and better at it over time.
And what jurisdictions you don't invest in, because the investment of Franco Nevada has actually been quite conservative, I think.
Yeah, absolutely. We are the ultimate risk-off company. So we're looking to get rid of every risk possible. When we're looking at our deals, the initial investments, we're seeing what can we change in our structure of our deal that pushes the risk back on the operator versus us taking it. And what do we know that they want to maximize? Let's tie ourselves to the thing that the operators we know will always want to maximize. Generally, it's production. But on some deals, for instance, we don't know if the byproduct will be as big a focus for the operator. Maybe they won't recover as much. So sometimes we'll tie it to their main product. Say, you pay us on a ratio of your main product, and you take the risk whether the metallurgy or recoveries work. And I think what's happened is if you do good due diligence, you can avoid a lot of challenges in terms of things going wrong on your deals. And when we do a look back, my directors, Tom Albanese is one of our directors, we're always saying, what is it that where we've lost money or we've taken an impairment? And we've looked back, it's actually not so much the deals that we've bought into and created ourselves, it's the ones we bought from other people because they structured the deal and they didn't protect themselves from a particular aspect on those transactions. And then those are the ones we've taken the largest hits on.
So what is it that actually has been driving the Franco investment policy? What are the key parameters that you take into account?
Well, this is where I take issue with the Mining Journal's assessment process, because if you looked at it today, it was 7.5% geology. And I would say it's 75% geology because that's the only God-given thing you can't change. All the other things, management, financing, jurisdiction in terms of the time, and that changes over time. And the other thing too is looking at the economics on stuff where you use NPV and IRR. And all that's going to do is push you into short-term, quick payback type projects. And where you make your industry or money, which is kind of where Pierre and myself come back. We kind of go back to the Noranda, Falconbridge, Inco days. We're saying all the mines are built at the peak of the market because that's where the money is made. But the old timers were smart. They said, we want to be in the long duration projects because what we want to catch multiple cycles over time because we'll never get the cycle perfect. And the other thing, we want to be in the low quartile cost projects because that means we'll lose the least money in the downturns. So we'll survive in the downturns and then make a big score in the various cycles. And that's what the Chinese are doing right now. They're looking for the big long-term resources. They don't care about NPV and IRR. And if you have the better quality resource, that's what's going to make you money over time, irregardless of what fiat currency you're measuring yourselves against. And I think Alistair that was talking this morning, I totally agree. You don't measure yourself on US dollars because that changes over time. What you got to do is the geology doesn't change. And I look back, what's amazing is what made a mine 200 years ago hasn't changed. If you're looking at an underground mine, you need a quarter ounce. It doesn't matter what the price of gold is or the inflation is at a particular time. You need a quarter ounce minimum to start an underground mine. You need to get a payback. And once the mine is built, you need at least a tenth of an ounce to continue in terms of marginal ores going forward. For an open pit, you need at least at 1.5 grams to make, get a payback on the initial capital. And then you can start mining maybe slightly less than 1 gram on an open pit once you get going and the capital is paid back. It doesn't change at all. And so when you start ignoring all the noise, because I think you get confused when you do spreadsheets and individual projects from time to time, because you get distorted by all these currency swings and FX changes and cost changes. Just look at the fundamental God-given asset, and that's what's going to give you money over time. And the rest of it is noise.
Well, I think a very important change that has occurred is that the Chinese are driven by the geology, and the
Yep.
Chinese are going over to jurisdictions, and they find it cheaper to fix the jurisdiction than to fix the geology.
Mm-hmm.
But Franco is the opportunity to participate in development of the mines that you've got already in the portfolio at
Yep.
no cost to shareholders.
Mm-hmm.
Now, that's your driving force, is it not, to deliver to the shareholders?
Our driving force is to have a permanent, non-diluted right on great geology forever. So I love that your previous presentation, Katrina was talking about Crawford Nickel. We have a royalty on that. Great large resource. I'm counting on them to get developed very quickly, but I can be very patient because I think at some cycle, it will go forward and we'll collect the money and make many, many multiples of what we've invested into it.
Yeah, but we've got to develop these resources, and Canada and America, I don't think, well, Quebec's not too bad, but in general, they're not supportive enough. And this is because of all of the regulatory claptrap that's come in.
Yeah,
And I recall in 1997 at Bre-X, when Bre-X occurred, and it occurred because the geology wasn't there.
Mm-hmm.
But the directors of certain companies, Barrick and Placidome, were deceived.
Mm-hmm.
So I was in Toronto at the time, and David was there, and he was really quite angry about the crookery and the shenanigans that had been going on. And you were on the committee that introduced that regulations
Yeah.
that changed the Canadian. I mean, for a while, the Australians gained because the Canadians are over-regulated. But
So,
do you think that we are possibly over-regulated with ESG and all the rest?
well, what we're talking about, we created what we call the 43101s in Canada, which is the sort of the standard now, and everyone has to do a report that came out of Bre-X. I was on the Mining Standards Task Force that created that. I can tell you, it was a lot of angry company executives about it because
Indeed.
I got tackled once in the subway. Remember Toronto? He had a bit to drink and he was angry because it was going to cost him so much money to have a consultant to sign off on it. Now it's a milestone for companies to get their 43101 and be able to take that to investors going forward. Are we over-regulated? What I'm proud of is that, subsequently there was the global financial crisis where banks got discredited. And mining companies actually in the early 2000s had actually a better reputation than, say, most banking institutions because we'd gone through this whole thing where we had to expertise our business. And I think it's been good because we haven't had a major fraud since then. We had that Southwestern in China, which was a little questionable, but was never done, never a proper 43101 done on it. And I think what's made it made it much better destination for institutional investors to go to because they needed that extra check and balance and some control. You can't have anyone coming in and waving their arms and saying we've got the biggest thing in the world. It's got to be something put in perspective with proper language so it's measured. And I think those are good things to have. Are we over-regulated? I think in terms of the gatekeeping to get new projects done, it's been a huge challenge. Every group in the world seems to be now want to have the ultimate veto on projects or gatekeepers on projects. But in the last year, I sense a sea change that you now have governments like in Ontario and Quebec that, they're saying it's critical minerals, but everything is a critical mineral. So all these projects that had nickel in them, now they've got a little cobalt or, lithium attached to them. And so they focus on those particular elements. And the governments are now giving us grants to accelerate it. Governments are now in Ontario, just a couple of weeks ago, they're trying to shorten up the permitting sequence. We never had this friendliness before. So I regard it as one of the most encouraging things I've ever seen in terms of this focus now of onshoring production and metals and new mines. And I think it will be able to bring even my evil gold mines, even help that process, because I think it's going to help all companies going forward. So I think there is some improvement right now. I'm very encouraged.
Well, I think it's a good thing that some governments are realising that they need to support the mining sector rather than exploit it.
Mm-hmm.
But looking forward now, one of the problems is that we've been in a bear market for a while for resource stocks.
Mm-hmm.
It's been good for Franco because Franco's been able to continue to acquire. But looking forward, how are we going to be developing these projects, and can Franco be more than a royalty taker? Can Franco be a financial supporter? You got $2 billion available, which most of us don't have.
Yeah. So in terms of my outlook for the junior stocks, et cetera, it's been the same in terms of, if you look back the last 30 years, what got people in was when you had the big winners. When you had the diamond discoveries that people came in, you had Voisey's Bay, that brought a lot of people in. When Barrick discovered Gold Strike, or the Hemlo discoveries, we need to have a major discovery made by a junior. Then people say, look, I can make 100-bagger on an exploration bet. I'm willing to lose money on the next 10 because I want to get involved in the next 100-bagger. And so we need to have some examples of wins. And until that happens, I think everyone's kind of sitting back saying, geez, it's been a couple of decades now before we've had a real run in terms of an exploration success story. So I think we need to have a new camp discovered that will generate some success stories. That will bring the investors back.
Yeah, but it's a bit of a horse before the cart, really.
It is, but
how do you raise the money to do the exploration to make the discovery if you're in a bear market?
well, but that's happened in the past. When you look at Hemlo, and that there was very little going on for gold in the 70s because it was just a tight market. And what would happen is that when they made the gold started moving, people started going back and looking at the records, saying, well, where were the gold intercepts? Oh, there's this little thing along the Trans-Canada Highway, and it turned out to be a play that got the whole market moving. Murray Pesum and the excitement, the whole Vancouver Stock Exchange lit up. And so everyone says, if that can exist right beside the Trans-Canada Highway, where else can we find things? And that would open up the purses for a lot of people.
Yeah.
And so we need to have, unfortunately, the cart first to make all those other horses, be applied to the industry.
Yeah, you're leaving out a very important point with Hemlo, which was the big discovery of 1980, was that the actual discovery was made with the 97th drill hole.
Yeah.
And nobody is prepared to finance beyond the first 10 or 12, and then we'll see how you go.
Yeah. Point taken.
Right.
Yeah.
So if we are looking ahead, Franco has got a very large portfolio of projects which are not advancing much at the moment, legacy stocks. If you start to spend the money on them and advance them, you become much more than a royalty company. You become a royalty project generator, but project generators have not caught the attention of investors. They're all at big discounts.
Yeah. And the challenges for investors is mining projects take just too long. And so I think someone was talking earlier, you can't apply a 5% discount rate, or I think as Tom was saying this morning. Well, if you think about it, the average project, if you're successful, you're still 10 to 15 years. You apply a 5%, your initial monies up front are worthless. And if you actually think of base metal projects, they work on a geologic timetable. Cobre Panama was found in the 60s, it only went into production a couple of years ago. And so most of these things will sit on the shelf waiting for the smelters to decide when your turn is to get developed. And so it'll be 30 to 40 years. Well, as an investor, which is what I am, I can't afford to be upfront on that expiration with that time value of money because I do have to put a DCF on those dollars, or can I buy something later on that is a resource that I can provide the push? It's going to be more expensive, but I have a better return and a more line of sight in terms of that outcome.
Yeah.
But the pure early stage stuff, I think this is why most of the mining companies you look at, the big gold companies, they've gotten out of the greenfields exploration business because they're making, again, that business decision. They say they'd rather buy it than spend 20 years of, upfront monies, which is not as effective in terms of investment.
But it was the Poseidon boom in 1968 to 1970 that triggered the big bull market for exploration.
Yeah,
And we haven't had that for more than 10 years.
that's right.
And
Yeah.
how does the projects get to the level where Franco Nevada says, oh, this is very interesting. Somebody's got to spend the money.
Yeah, well, but that's why we have those other 250 projects that you think are laying fallow. But most of them are in great grounds, and there's going to be cycles. What will happen is that when the market is hot, people are then going to be looking for new projects, and they'll be willing to spend the risk money up front on those projects. And they'll use government-assisted funding, such as flow-through funding that we have in Canada, that helps make it cheaper. Quebec makes it even more subsidized, that you can more write-offs to make those investments. And then there's cycles like when I first started in the business, the oil companies thought mining was to be a good thing. And they were throwing money in terms of grassroots surveys. And I was part of these things where we went through the Northwest Territories doing uranium surveys and in the Cordillera looking for base metals. They would put major campaigns to try to do fat finance. So they were making that longer term investment. So I'm kind of looking at it, say, we might come to that as well, where you get, other companies. We're talking about automotive companies now that want to sort of invest in paying and developing mines. I could see a time when the commodities get really high. They say, we need to be providing capital to help that chain advance and provide that. And I think it's actually a good thing for the industry because I think for too long, and it was my personal thing, I watched mining companies try to say, oh, our job is to deliver metal for the industries, that, to make sure there's not a shortage. Well, what happened is all the automotive companies and et cetera, they basically screwed the mining companies because they were always overflooding the market. The mining companies basically got their marginal cost of production back. They didn't get a return on their capital. And the automotive makers, made out like bandits. They got all this cheap metal without having to invest any capital themselves. And it wasn't good for the companies because they had to lay off employees with every downturn that occurred. It wasn't good for the communities because they had this boom and bust type occurrences and made it very unattractive to work for the business. And so I think having something where there's more, we spread out the capital requirements of the industry, more people are taking the risks and have a vested interest in making these projects going forward. I think it's going to be a lot healthier for the industry and a lot healthier in terms of the supply-demand balance going forward. So I don't think us trying to control all the optionality on these projects is a good thing for ourselves. We're just going to create more boom and busts in the future. I think it's got to be a larger society commitment saying we need to have this type of stuff going forward. We can bring the mining companies can bring the development and operating expertise, but I think that longer term commitment, capital investment has to be done both by the users of the metals and consumers of the metals and the companies that do them and the governments. And I think that would be a much better equation going forward.
It's another interesting point is the royalty companies are the beneficiaries because where you have a royalty, you have a royalty on a large piece of land, and the project which has occurred and is running out of ore, the major has got no alternative but to spend money on seeing which direction it goes.
Yeah.
And this is a royalty company sits there, doesn't have to spend any money, and when the demand is there and the major moves, the deposit continues into the royalty ground, and you benefit for no cost.
Yeah, but I've had the thing where people say that in a negative fashion, but the thing is we paid for it up front. So I've come, and talked to big institutional accounts here that have a lot of mining expertise in London. And they say, you idiot, I worked out what you paid for on that particular project. You're getting like a 3.5% return.
Yeah.
And I'd rather buy into an operating company that's getting a 20% return on their project. And what they don't understand is that, no, I'm never going to have that operating and capital cost overrun, but I'm fully counting because we've been able to look at the geology, we've looked at the analysis, we looked at the drill holes and say, it's not a skarn deposit. It's one of these structural break type deposits that can go to depth and strike extensions for miles. And so we see that there can be a multiple of upsides on this project. And we see that the company's got to have a big capital commitment in terms of a hungry mill, an operating plant, a power plant. We know they're going to put more risk money, and that risk money is going to convert more and more of those resources into reserves over time. And they'll find more resources on top of that. So we're actually paying often for at least a good part of the resources and even beyond that. And when people are trying to reverse engineer their deals, they don't see that. And so they think we paid way too much. And then they complain later on, we got too good a deal, that we're taking too much of the profits of the mine. And we're saying, okay, did you put your equity into the company that particular time? And I remember there was a global financial crisis. There was Coeur Mining that was looking to finish off the Palmarejo mine in Mexico. They needed $75 million. Their market cap was $75 million. And so we put up the $75 million for a stream on that one project. And we've gotten a fabulous deal. We've made 10 times our money on that project. But I have equity investors. So you raped the company. And I said, no, if I take an equity, I would own 50% of every project in that company right now. And that company's got a market cap, last time I looked, of couple billion dollars. And I'm saying, I would have owned 50% of all that. So this was actually the smartest financing that Coeur could have done at that particular time. And I think people are now looking, saying, this is a good thing that companies now have an option in terms of how they're going to finance their projects going forward. Because think of any company trying to raise money right now. If it's an equity financing, they'll give away half their company right now. If they do a bank financing, no, they probably can't even get it. And if they do, they're potentially going to bankrupt their company. Or they're going to take someone who says, actually, I believe, I've done the work on it, that there's a much bigger upside. I'm paying you up front for that bigger upside up there, but I'm going to be your partner if you're successful going forward. But I'm taking the risk if the commodity goes down or if that reserve is not there at the end of the day. But I've done enough work on it, because we get to do our technical work, that we'll make that bet with you going forward, because no one else is making that bet with you. And so when people complain about royalty and streaming financing, I believe those are the ones that are actually taking their shareholders' interest into account the most, versus other companies that won't do the deal, but then they bankrupt themselves by taking that debt, or they dilute their shareholders to nothing because they just want to not have a burden of paying a royalty in the future, but they're not shareholders themselves. They're just entrenching management.
You don't have to justify anything. I mean,
All right. Well, I get the challenge.
Is there for companies. Unfortunately, these days it's social media, which is not regulated, that makes appalling judgments. But David, it looks like we're out of time.
Trevor.
So perhaps the next lifetime we can do another award. It's been a long time.
All right. I'm never going to die. I'm having too much fun. So
Okay.
Good. All right. Thank you very much for this. Appreciate it.
Thank you.